Make sure you meet the minimum requirements before restructuring your mortgage or getting a loan modification in Chicago. Restructuring an existing home loan to avoid foreclosure in Cook County is a sensible consideration for some Chicago, Illinois homeowners, but not all. Unless the minimum requirements are met, you may just be spinning your wheels. For obvious reasons, the qualification requirements for a mortgage restructuring, also known as a loan modification, are quite different than those for a first-time home buyer. The Cook County homeowner's attempt to restructure usually indicates some current, or recent, financial duress on the homeowner's part, who in all likelihood is trying to save their home and stop foreclosure. Understandably, a lender will likely be very strict, even unforgiving, depending on the homeowner's circumstances. Similar to a first-time home buyer, a Chicago, Illinois homeowner attempting to restructure or modify their loan has to be able to prove they can in fact afford the new monthly payments. Unlike the first-time buyer, those attempting to restructure typically experience a harder time proving to the lender that even though they have recently suffered a financial setback, they are in fact back in the saddle and have adequate monthly cash flow to enable them to afford what is likely to be a higher monthly mortgage payment. It is proving to be a bit more troublesome for those with damaged credit when applying for a loan modification in recent times. Conventional loans are usually not available in this circumstance, leaving only those loans offering much higher interest rates. The caveat here is that along with the higher interest rates comes a higher monthly payment, unless the homeowner has accumulated a substantial amount of cash to buy points, which may possibly kill the deal if the borrower cannot prove conclusively they will be able to afford the new, higher mortgage payments. Income requirements for restructuring are the same as that for a first-time conventional mortgage loan. The maximum amount of income allocated to a mortgage payment cannot exceed 28%. As mentioned previously, the difficulty comes with proving to the lender that the monthly income will be sufficient to cover the higher monthly mortgage payment. A word of caution is in order. As tempting as it may be to inflate your income or downplay your debts and other financial commitments in order to improve your position, it is a fraudulent offense to lie about your income on a mortgage application form. Employment. Lenders all seem to follow the same guidelines regarding employment. Regardless if the borrower has a job or is self-employed, they still have to provide the following documentation. For all loans, complete last year and the previous year's signed federal tax return forms, and last year and the previous year's W-2 federal forms. 2 most current pay stubs within 30 days for each borrower. Last 3 bank statements for all savings and checking accounts. Evidence of additional income, rental agreements, child support, alimony, military allowance. For self-employed borrowers, last year and the previous year's signed federal corporate tax returns. Last year and the previous year's signed federal partnership tax returns. Last year and the previous year's and current, calendar or business year, year-to-date, signed profit and loss financial statements. Current year-to-date, calendar or business year, signed state tax return forms. Conclusion. In what was an act of too little, too late, the government stepped in and began examining some of the questionable lending tactics which started the whole sordid mess. As a consequence, lenders have been forced to enact stricter loan requirements and funding obligations to negate the need for government legislation. While this strategy has provided a stopgap measure to reduce future abuses and irresponsible actions, it offers very help to those borrowers who are struggling to avoid foreclosure in Cook County and keep their homes. Homeowners and buyers in Chicago, Illinois today can expect much more stringent requirements from the lenders. Credit score requirements are becoming increasingly strict. If you're looking to restructure an existing mortgage, make sure you have money for closing costs and a substantial down payment along with solid documentation of your income. And above all, don't let the clock run out on your efforts.